Welcome back. We are here with David Rosenberg, founder and president of Rosenberg Research. Ed Devlin, also with us, senior fellow at the CD Howe Institute. We've been talking about the economic roadmap ahead for Canada and the United States, what happens with interest rates. David, you were talking before the break about your big concerns that if rates stay at that current level, that we've got some bigger questions for the Canadian economy. Ed, when you think about all of this as an investor, remind us how you've been positioning in the market recently.
Yeah, I mean, the trade I like the best was two trades, my two top trades that I have high conviction on, if you will. One is U.S. agency mortgages. These are Fannie Mae, Freddie Mac. These are bonds that are backed by households all over the U.S. They're AAA rated. They're super high quality. They are the yield pickup you can get over U.S. Treasuries is close to where it was in 2008. Okay, and ask yourself why. And the reason why is because the U.S. yield curve is inverted. In other words, short-term interest rates are higher than longer-term interest rates, and they've gone up significantly because the Fed's hiked our rates. Both of those really damage mortgages, okay, the way that market works. So hence why it's back to 2008 levels. So for a AAA rated asset, you're picking up another 1.6%. These currently yield like 6.2%, okay? Now, if David and I are right and the Fed's going to cut rates, what's going to happen is short-term rates will fall a lot faster than longer-term interest rates, and the mortgages will love that, and that asset will outperform. Those come screaming in. So I really like, if you have the view that we're going to have this rate-cutting environment where the yield curve will normalize, go back to being steep, not inverted, U.S. agency mortgages are, to me, the home run. Okay.
And is that appreciation of the asset?
Yes.
It goes up in value.
It'll
so
go
you're
up in
locking in this yield now, but when this dynamic plays out, if it plays out, it goes up, kind of like a stock goes up.
Exactly. So you're getting 6.2% to wait. And if our view is right, you'll get another 10% on top of that.
And that view, just to clarify, because we talked a lot about the Canadian economy, is that the Fed, even though, the big takeaway from yesterday from Jay Powell seemed to be that the next move won't be to hike interest rates, but you guys are in the camp that interest rate cuts are coming in the United States sometime soon?
They'll come first in Canada, second in the U.S.
Yeah. What kind of move, David? I mean, we sit here every day, we talk to people, they remind us that coming into the year, there was sort of an expectation maybe the Fed would cut rates 6 times or something like that in 2024. And then as we move through the year, keeps getting pushed out. Then maybe it's, 1 or 2 times. There's a complication with the presidential election in the fall. Maybe there's no rate cuts at all. So when you guys think that rate cuts are coming in the U.S., what does that look like? What's the number?
Well, let's just say that firstly, the 6 rate cuts that were being priced in at the beginning of the year, the markets were front running the Fed. The Fed had 3 cuts in the dot plots, and then the market just was like the Bugs Bunny and the Roadrunner. They were never going to cut rates 6 times. I didn't even think they were going to cut rates 6 times. I didn't think they were going to start as early as March. There wasn't going to be enough data. So look, he said that Powell still believes that inflation is going to come down to target. Less confident that it's going to happen as quickly as he had thought at the beginning of the year, but he said that the current stance is sufficiently restrictive, which is what he said, that the move towards 2% inflation is intact. It's really a timing matter. So I guess that for market timers, timing matters. They're not going to move. It would take a lot. It'd take a lot for them to move by the July meeting, and then then we're talking about the U.S. election. So they want to stay silent in September. It may not be I think the November meeting is November the 7th, okay, which is unusually late for the November meeting. Why? Because the election is November the 5th. They're probably not going to move unless something dramatic happens until November. But then when they do cut, and I agree with Ed when he talks about the Bank of Canada in this regard, when the Fed cuts, it'll be under totally different market and economic circumstances, and cuts will come hard. And that's probably going to be more end 2024 into 2025. But like he said, like Powell said, most important thing he said that policy is restrictive. And he said for all the people that don't believe that interest rates are hitting the economy, he specifically said that they are hitting the economy in the 2 most credit sensitive sectors, which is what? Housing and business capital spending.
We have about 2 minutes left. Ed, you were mentioning there were 2 trades that you like. I let you get through one before I cut you off. What was the second one?
So the second trade I like a lot is if you look at the index of the top-rated corporate bonds in the U.S. and in Europe, the investment-grade corporate bonds, they trade at the same level, Europe versus the U.S. And it's very obvious to me that that doesn't make any sense because Europe is going to roll over a lot faster than the U.S. is going to roll over. So you're sitting there. I would be long the U.S. and short Europe in the investment-grade corporate space. And when you do it at the exact same spread or yield, means it doesn't cost you anything to have the trade on. But I think the asymmetry, the odds of Europe outperforming the U.S., I think are very, very low. The odds of Europe underperforming the U.S. are very, very high. And I think that's a great trade.
Right. David, I know you focus more on the numbers, but like broadly speaking, I am listening to what you're saying and the risks that you see on the potential horizon here. How do you feel about the equity market going forward? We've come off our best levels of the year, no doubt about that. I said the S&P is down about 5% from the peak, but when you get asked by clients about the stock market right now, what do you say?
Well, look, the stock market, when I get asked, is synonymous with the S&P 500.
Right,
and
right.
no, I don't like the S&P 500 because it's trading in the top 10% of price earnings multiples of all time. However, I like India. I like Japan. Secular tailwinds. Hong Kong is a great value play right now. And if I'm right on interest rates and the yield curve steepening, look, that's going to be very good news for the banks. And lower rates are going to be very good news for rate sensitives in the stock market, like, for example, utilities, selective REITs, telecom. So the dividend payers, rate sensitive stocks that are not correlated with the economy will be relatively good places to